So I think it's the snapping of the stock market is the key issue right now, and ambushing people's emotions and generating some fear that will move more money into already what's going on in gold and silver to the upside. Because silver continues to act like that little wild dog on a leash. Sometimes it outperforms gold, and there's other times where it's, you think, oh gosh, it's never going up. Okay. But watch the mama market. As long as gold is steady, firm, ongoing, silver will follow it. Okay. There's no issue about that. You're not going to have an up in gold and down in silver. The short-term swings you see day to day, or maybe even hour to hour, they're to be ignored if they're down. And then they outpace gold sometimes. So I think we're at the edge right now in this advance in the monetary metals, where if you engage any more, you're going to really start to see more speed in both markets. And at that point, I think you'll see silver rush to the front again. The dog on the leash pulling mama this time instead of being pulled. And I think right now the thing to watch, and what we do at MSA, is we look at all four major asset categories. Foreign exchange has been dull for a year and a half. It hasn't played a role really in moving markets. Okay, dollar, euro, that kind of stuff. It's been horizontal. The bond market recently, starting in July, shifted up enough in price, drop in yield, to break through some metrics for us that indicate probably over the next quarter or two, it's going higher. Yields will go low. Now, in the last 4 weeks, you've seen the opposite. You've seen T-bonds pull back, while what? The S&P has gone up. Okay? The Fed cut rates, the S&P's rallied for 4 weeks. This is exactly what happened, by the way, in 2007 at the top. Fed cut rates, market went up for 4 weeks and topped. Okay. The bonds have become inverse to the stock market, despite the seeming illogic of that. In other words, if rates go down, that should be bullish for the stock market, right? The long end. But it was the case between 2000 and 2002. When the stock market went down, rates went down. Bond market price went up. Gold went up. 2007 to 2009, stock market went down big, bonds went up, and gold went up, except for one brief month in that period for gold. It was down. So both gold and T-bonds have been firming relative to the stock market, but they've not really unleashed on the upside in a way that's, headline generated. And I think the reason for that is that the stock market, while it's dancing around up here, every other day, Dow or S&P makes new high, new all-time high. You hear it on Fox Business or CNBC. And each time it does it, it's like a marginal new high by 5 more S&P points. And then they pull back for a couple of days, and they go up and make another new high. And it's constant headline, new highs. Meanwhile, the NASDAQ 100 so far has not made new highs. It made its high in July. I think it's still below. Now, maybe it'll make a new high. But it's toiling around. And the thing I think that's important here is the stock market's dynamics. While price looks super good, it just keeps sort of going up. But when you run long-term momentum studies of it, like we do, and look for structure, meaning something that it could break that indicates it's shifting to the downside, we're dancing on glass on these momentum structures. In other words, we're not breaking them yet, but we don't seem to get up and away from them. Like, it's weak. Momentum suggests it's weaker than you think it is. And I've gone back through history, and I've lived through a lot of this stuff too, but there's almost no time in the history of the stock market where there's been a sudden dramatic drop, not necessarily a crash, but a dramatic drop that was warned by price. It's always warned by the momentum of the market breaking something, if you know how to measure the momentum, structurally speaking. And right now we have, I would say, maximum pending negative structures below the stock market, S&P and NASDAQ 100, that suggests that if you sneeze, drop 1% or 2%, you're going to drop 5 or 10, and then you're not going to stop. There's so many dominoes, so many triggers that are clustered right below the market, and they adjust up under the market. As the market rises each month, let's say a little bit, those numbers come up. So the market's not really escaping stepping on the minefield, because the minefield is just, if you follow that logic, okay? So I think the key to create market drama for the bond market to the upside, drop in yields, for, again, only for a quarter or two. I'm not looking for something long-term. And gold and silver to really launch is to engage the stock market to the downside, because we know what's going to happen then. You know, there's a lot of cheering right now because the banks have gotten strong of late. In fact, there's been some days recently where the S&P will be down, the banks will be up. And they've got some good earnings and so forth and so on. But when I look at the technicals of too many of the large banks like Citicorp, Capital One, or Wells Fargo, and we ran a few others, we picked them almost at random. And when I ran some of their momentum studies, they showed that those, while the price charts look like they're chest beating happy, okay, and everybody's been cheering them lately, the momentum chart suggests not so. It's not so good looking. In other words, if they sneeze a couple percent, they could begin to break some things that would shock people. If you go back to, I think it was March of 2023, we actually had a bank crash, meaning there was a period there where the S&P had already made its low in 2022 and was firming up. And in March of 2023, the banks, and MSA called this, by the way, we could see there was vulnerability on momentum structures of the KBE, which is the bank ETF. And this was in late January. Well, in early March, you triggered those technicals, and you actually had a 30 to 35% drop in banks in a matter of a month. That's of crash dimensions. The overall market suffered a little bit. The banks suffered a lot, very dramatically. And of course, that woke people up. You know, there were the stories about the mid-tier banks and so forth, so on. During that time, gold went up. So in answer to the question, as an example, the banks actually had a crash and gold shot up strongly during that same period. I see the overall market going down, benefiting gold. This has historically been the case in other prior major bear markets in the last 20 years. 2000, 2002, gold went up, stocks went down, and gold kept going. 2007 to 2009, and on through 2011, gold went up. Well, the stock market went down to 2009 and took it several years to even get back to its high. Meanwhile, gold, took off. So I see the stock market break is fueling the gold market, and especially the miners, as portfolio managers move money into that which is working. Whether they like it or not, whether they understand the reason for doing it, they're looking around at sectors that are doing well, and it's the miners are doing well, and the miners are cheap, and so-and-so bought them 6 months ago, and he's doing quite well, maybe I need to join in. And it's a very small sector, miners, gold miners, and silver miners. So, if money flows in, it's a wet bar of soap being grabbed. And the other factor is there, when the stock market breaks, historically, that's when the data points shift. So today we got some good data points, right? Okay. You usually don't get an ongoing negative pattern in the data points until the stock market tops. You don't get them ahead of the stock market break. You get them afterwards. And what would that do to the central banks? We know what it would do. Pedal to the floor. Monetary policy would ease, money supply would grow, rates would drop. And that helps fuel gold. It's a factor that could help pop the bubble, because it's an ambush. Meaning people aren't really, they expect it if Trump loses, okay, one side. But I'm arguing that it doesn't matter. You're still going to have an upset. Now, I'm not defining what it's going to look like. I'm not advocating or anything. I'm just sitting and observing it. And the University of Virginia Department of Politics poll validates that. That was a year ago. We know that those tensions and hatreds have risen since then. So whatever data points they came up with then are even worse now, you can bet. In fact, they may have updated it. I don't know. And they're looking at it objectively and scientifically. They're not opinionating. And so it's just not in the market, and we don't normally have that kind of outcome. In fact, I can't think of one in my lifetime where you've had that kind of outcome. You have it in third world countries, maybe sometimes in Europe to some extent, but it just doesn't happen here. Well, if it happens here and you're a foreign investor in the U.S. markets, and you suddenly say, gee, this looks like Venezuela or something, or you get my point. It creates uncertainty and therefore fear, and fear creates change and emotion. And people want to protect themselves, and portfolio managers want to protect themselves. So they will quickly hurry to whatever is working. And I'm arguing technically that already gold we know is working on the upside. It's not exploded yet. It's still going up in an arm wrestling manner. So there's not a lot of emotion in it yet. That certainly in the United States or the Western world. It's mainly, buying from the other part of the world. But if all of a sudden we get rattled here because our stock markets start to break, then emotion gets injected. Now we know people are already hurting on the consumption level, the cost of goods and services. The credit card, with delinquencies are rising and they're pinched. What happens if all of a sudden everybody's retirement account drops 20% quickly, in a month or two or three, or 30%? All of a sudden the pain becomes excruciating.